Consumer spending is hanging in there pretty well. Of course, consumer discretionary as a cyclical sector is under pressure right now, and we think the cyclical sectors are likely to be under pressure for a while. So we're taking a more defensive orientation in our portfolios currently, given the volatility that you're seeing.
When it comes to that consumer, we know that consumer spending in that gross domestic product, that famous formula, right? They make up, estimates are 70% of GDP.
Yep.
So how critical is it for that consumer to remain confident and continue to spend in order for this market and the economy, we know that they're not the same, to move up from these current levels?
Well, I think it's critical. And, I think the underlying health of the U.S. economy still looks pretty strong here. So when you consider what's happening in the markets, right, we've had a 16% drawdown in the S&P 500 here, worst December since the 1930s. So I do think most of the damage is done here in terms of market declines. That doesn't mean that we're going to turn around very quickly. So we're about 3 months into this correction from the high that we saw in October. And bottoming is typically a process. So I foresee the first part of the year as sort of a continuation of what we've been seeing lately. I don't think we're going to have much more in terms of declines, but I think it's going to be sort of flat, unrewarding markets with a lot of volatility. We think that the pieces are going to come together to get more bullish in 2019, but it's going to take a while, and we've got certain signposts which I can talk about.
All right, so those are the kind of broad ideas that you have. So let's lay out a strategy. If you are an investor and you take that scenario that you are predicting will play out in the first part of the year, how exactly should investors be positioning now, and what should be going on shopping lists, and what kinds of opportunities have to present themselves before you deploy some of that cash to get back in the market?
Right. So I would be crouching in defensive position.
Even with valuations the way that they are right now.
Yeah. We're overweight cash. We're neutral on equities. We're underweight, fixed income, real estate, commodities. As I mentioned, I do think that we're going to see an inflection point next year when it's going to be time to get more aggressive. So you're going to want to own things like small cap and value and emerging markets. But the signposts, we're looking for clear signs that the Fed is going to pause, clear signs that the dollar has peaked and is starting to decline. I think the global slowdown is going to be broader in the first half of the year, so we want to look for signs that global growth is bottoming. And then, of course, that earnings are hanging tough. After the gangbuster results that we saw last year, we still want to see signs that earnings are going to rise in 2019.
One of the things that we've been asking many of our guests on air over the course of the past few weeks, we've noted in the CNBC Fed survey that more and more respondents expect a recession in 2019. Not everybody, just a shy of a quarter of them. How do you feel as a money manager? Do you feel as though we are destined for a recession anytime in 2019?
I still judge the risks of a 2019 recession as very low. So the key indicators that we focus on in terms of, we have our recession dashboard, the yield curve, the Conference Board leading indicator, high yield spreads, and initial unemployment claims. And when you look at the one that is a little bit concerning at this point is the yield curve, but it's really an inverted yield curve that signals a recession is coming, and even then it's a pretty long leading indicator. You typically, once it inverts, you're looking at least a year before, and the markets don't really respond to recession risks until about 6 months before. So my sense is we still have one more up leg in risky assets. And we still have at least a year plus before the end of the economic cycle.